stocks in Asia. I'm talking to Aaron Smith, Managing Director at Superfund Financial in Singapore. In fact, not just Asia, we're going to talk about stock markets around the world. Superfund is essentially a quant fund, a macro fund, computer-driven. And in terms of stocks, it doesn't pick stocks, Aaron. You do buy and sell, or buy and short, index futures, correct?
That's correct.
And
so
what are your models telling you? Sorry, carry on. I was going to say, what are your models telling you at the moment?
We were short in most of the equity indexes for most of the past 18 months up until March, April. We've given back some of the profits we've made and started to close some of those positions. The short positions in equities were one of the reasons why all of the Superfund strategies had double-digit returns in the past 18 to 24 months. But I think that if you look at equities as an asset class long only, that's really the investment tool of the last century. Certainly in the past decade, equities gave you zero return, whereas managed futures dramatically outperformed equities. So what we look for as an alternative to long-only equities is a managed future strategy like Superfund. If you invested $10,000 in equities back in 1980, it would grow to about $80,000 today if you look at the S&P 500. Whereas $10,000 invested in managed futures today would have grown to over $600,000. Simply by making an average return of 15% a year, what you'll do is you'll have a huge compound interest, which means that $10,000 has grown to over $600,000 at this point. So certainly we think the smart money is with systematic strategies like managed futures and probably not looking at equities at this point.
Right, but equities have continued to run up. So who's buying? Retail investors?
Well, no, I think there's certainly a reversal. I mean, stocks were so oversold, and there had to be a reversal in equities simply because of what the governments worldwide are doing, especially in the U.S., with over $12.8 trillion in stimulus and bailout packages in the United States. That's more than the total equity value of the entire U.S. market. The U.S. equity market's only $9.5 trillion. So if you've thrown $12.8 trillion at a $9.5 trillion market, naturally it's going to rise artificially in the short run. But I think any investment strategy which is predicated on the government's intervention is not necessarily going to be a winning strategy and certainly going to be unpredictable.
Okay, let's talk about currencies then. We have an email that comes from Pedro who says, what view do you take on the prospects for the carry trade and Latin American currencies in that perspective? I don't know if you can answer that one specifically, but either way, you can talk about where the trends are in currencies and whether the carry trade is back on.
Well, look, I mean, if you look at the Latin American currencies, I think I would feel a lot safer in commodity-based countries like Brazil. That's going to be probably better off than staying in U.S. dollar denominated assets over the next couple of years. We don't know when, but we know eventually that the U.S. dollar should have a massive erosion in value based on the huge money printing that's going on. So basically, the commodity-based countries like Australia, Canada, Brazil, they should have a much better outlook in terms of their currencies. But whether to decide which currency to buy, the best answer would actually be gold. That's why Christian Baja, the founder of Superfund, launched the world's first gold-denominated investment fund in 2005, Superfund Gold, and that's had an average return of about 33% since 2005.
And what currencies are you short at the moment?
Well, I think that the obvious choice would be, in the past year we were short the pound sterling, we were short the Aussie dollar, and we made money long in the U.S. dollar and in the yen. That doesn't mean that those trends will last. So certainly our active trading strategy is not, taking a pure long or short position. We're trading based on the technical trend in the market. So in the past year, we actually benefited from U.S. dollar strength and in the yen, but I wouldn't really advise that as an investment strategy going forward for investors.
Okay, we have an email. This one comes from Danny, who says, what are going to be the most volatile markets and how can an investor best trade these? The point here is volatility has come off quite a long way, but what do you think?
Well, I certainly wouldn't speculate as to what are going to be the most volatile markets, but I think equities will continue to be extremely volatile. Maybe not as high. We might not see the VIX go to 70 or 75 like we've seen it in the past, but we do expect volatility to remain high. I think the best way is to go into a directional trend-following strategy like a managed futures fund That way you don't have to speculate about, which market, is going to be volatile or not volatile. You just bet that there will be pure directional trends either on the upside or on the downside, and that a quantitative managed future strategy can actually benefit from that as opposed to a pure long-only equity strategy.
Okay, Aaron, thank you very much indeed for that. Worth noting, of course, you do pay for all this technology. Superfund sees management fees 6%, performance 35%, and there's a front load. I don't know if you can get out of that if you put enough in. Aaron, thank you very much indeed for that. Aaron Smith, Managing Director at Superfund Financial in Singapore. Emails are answered after the break. Asia Edge at Bloomberg.